Episode title: Corporate Scorecards, Decoding Earnings Reports and Their Market Impact. Introduction.
Welcome back. Today we're broadcasting from a luxury yacht, gliding past New York City's iconic skyline. From the Statue of Liberty to Wall Street, a true beacon of finance and innovation. Right, Max?
Absolutely. Cruising past these icons of economic prowess sets a perfect stage for our discussion on global market dynamics and the cutting-edge technologies shaping our financial future, from AI innovations to the strategic roles of gold and silver in today's volatile markets.
In each episode, we aim to peel back the layers on how these advancements are not just reshaping the corporate giants, but also impacting the everyday investor and the broader economic canvas. From the towering skyscrapers housing major financial firms that influence tech investments to the bustling trading floors impacting commodity prices, today's episode is rich with insights.
Our discussion will navigate through the latest innovations in AI that are transforming industries, shifts in investment strategies amidst evolving market conditions, and a look at how major corporations are steering the future of the economy.
So whether you're a seasoned investor, a tech aficionado, or simply keen on decoding the forces that shape our economic landscape, you're in the right place. Let's dive into these intricate topics with the thorough analysis they demand. Ready to start this fascinating journey?
Absolutely, let's set sail on this explorative journey from the vibrant waters of New York City.
As we move away from the scenic vistas of New York and dive deeper into the financial waters, let's shift our focus to a topic that affects everyone from Wall Street to Main Street. Today in Chapter 1, Federal Focus Inflation and Interest Rates, we're going to unravel the complexities of the Federal Reserve's decisions and their ripple effects on the economy. What keeps the rates high? What could bring them down? Let's explore.
Chapter 1: Federal Focus Inflation and Interest Rates. The Federal Reserve keeps interest rates high, between 5.25% and 5.5%, to stabilize the economy. Despite the economic slowdown and moderated inflation, the Fed opts for a cautious stance. Rate cuts will only be considered when there's clear evidence of inflation consistently nearing their 2% target. This policy aims to stabilize prices effectively before fostering economic growth through lower rates. Financial markets have shown mixed reactions to recent economic data. Growing skepticism among investors questions whether the Fed can execute its projected rate cuts this year. Despite inflation slowing down, the Fed continues to see inflation levels as a concern, advocating a cautious approach to rate adjustments. This maintains a delicate balance as the Fed aims to manage inflation without stifling economic growth. The job market remains robust, complicating the Fed's policy decisions. Although a strong labor market suggests economic vitality, the Fed remains vigilant about inflationary pressures. Additionally, recent realignments in bond markets with economic indicators affect investment decisions and market sentiments, showcasing the interconnectedness of monetary policy and financial conditions. High interest rates significantly impact different sectors. Sectors like consumer spending and business investment, sensitive to borrowing costs, face challenges due to high rates. Conversely, these rates are essential for controlling inflation and promoting long-term stability. The real estate and consumer goods sectors, which are highly sensitive to interest rate fluctuations, may experience reduced activity due to increased financing costs. The Federal Reserve's interest rate decisions directly influence consumer behavior and economic activity. When the Fed increases interest rates, as noted in maintaining rates between 5.25% and 5.5%, borrowing costs for consumers rise. This affects mortgages, car loans, and credit card interest rates. Higher borrowing costs can lead to reduced consumer spending on big-ticket items like homes and cars, which can slow down economic growth. Conversely, lower interest rates tend to stimulate spending by making borrowing cheaper, though this can also lead to inflation if not carefully managed. The Fed's interest rate policies also influence the savings rates offered by banks. Higher interest rates generally increase the returns on savings accounts and fixed-income investments like bonds. This can encourage more people to save or invest in safer assets, potentially pulling money away from more consumptive uses. In periods of low interest rates, there's a tendency for consumers to invest in higher risk assets like stocks, driving up market valuations. One of the primary reasons the Fed adjusts interest rates is to control inflation. By maintaining a cautious stance and not immediately lowering interest rates despite a slowdown in inflation, the Fed aims to ensure that inflation returns sustainably to its target level of 2%. This cautious approach helps prevent the economy from overheating, which can happen if money remains too cheap for too long, leading to excessive spending and subsequent price rises. Federal Reserve policies have far-reaching implications beyond consumer wallets. They impact business investment decisions, government financing costs, and the overall economic growth rate. High interest rates might deter businesses from taking out loans for expansion, slowing down economic growth. On the other hand, if rates are too low, it can lead to an overheated economy and create bubbles in assets like real estate or stocks. Different sectors react differently to changes in Fed policies. For instance, the real estate sector is highly sensitive to changes in interest rates due to the reliance on mortgage financing. Consumer discretionary spending is also affected as higher rates might reduce disposable income and alter spending patterns. Let's dive into some common questions for Chapter 1, Federal Focus, Inflation, and Interest Rates.
Given the Fed's cautious stance, what indicators are they looking for to consider rate reductions?
The Fed closely monitors a range of indicators, including core inflation, employment rates, and overall economic growth. They're particularly looking for sustained trends towards their 2% inflation target, which means not just temporary dips in inflation rates but consistent signs of easing across various economic sectors. This approach helps them ensure that rate adjustments are made based on long-term trends rather than short-lived changes.
How do high interest rates affect sectors like real estate and consumer goods?
High interest rates typically lead to higher borrowing costs, which can significantly dampen consumer and business spending. In the real estate sector, this translates to higher mortgage rates, which can cool down the housing market by making home purchases less affordable. For consumer goods, the increased cost of financing big-ticket purchases like vehicles and large appliances can lead to a reduction in consumer spending, which can slow economic growth in these sectors. Chapter 2, Global Geopolitical Tensions and Economic Impact. The Middle East has seen heightened geopolitical tensions, notably involving Iran and Israel. Recent military actions have intensified, significantly elevating regional geopolitical risk. Despite these tensions, global oil supply chains have remained robust, largely due to strong global oil production and diversified supply routes. The presence of multinational naval forces has also helped stabilize key shipping routes, preventing significant disruptions in oil supply. Interestingly, oil prices have remained relatively steady with minor fluctuations. This stability is attributed to ongoing strong production and the effective use of strategic oil reserves, which have buffered the potential impacts of supply disruptions. The situation underscores the complex dynamics at play in global oil markets, where geopolitical risks are continually assessed against background market fundamentals. According to BlackRock's Geopolitical Risk Indicator, which has hit a yearly high, market participants are increasingly wary of geopolitical threats. This indicator is crucial for investors as it influences global market strategies and economic forecasts by signaling the level of risk perceived in the markets. Ongoing conflicts have led to some rerouting of shipping, particularly around the Suez Canal, which has increased operational costs. This has implications for global trade and could potentially affect consumer goods prices. While energy prices have been stable, the potential for future escalations could lead to higher costs, impacting global economic stability and inflation. The Middle East holds substantial strategic importance due to its vast oil reserves and pivotal shipping routes like the Strait of Hormuz. Disruptions in this region could have wide-reaching effects on global energy markets and overall economic stability, making it a critical focus for anyone involved in economic or financial planning. Geopolitical conflicts have long influenced global markets, often leading to volatility in oil prices, currency fluctuations, and shifts in investment strategies. For example, during the Gulf War in the early 1990s, oil prices spiked dramatically due to concerns over supply disruptions from the Middle East. This not only affected global oil markets, but also had a cascading effect on inflation and stock markets worldwide. Similarly, the 2014 annexation of Crimea by Russia led to international sanctions against Russia, which had broad economic impacts, including a significant drop in the Russian ruble and a decline in European stock markets due to fears of prolonged regional instability. Today, the ongoing tensions between major powers in strategic regions like the South China Sea and the Middle East continue to pose risks to global stability. The recent escalations between Iran and Western countries, for example, have heightened risks of disruptions in oil supply routes through the Strait of Hormuz, a critical choke point for global oil shipments. This has periodically led to increases in oil prices and has kept global markets on edge. In addition to direct economic impacts, these tensions also affect investor sentiment and can lead to significant capital shifts. Investors often move toward safer assets, such as gold and U.S. Treasuries, during times of heightened geopolitical risk, impacting yields and valuations in these asset classes. Different sectors respond uniquely to geopolitical crises. Energy companies with significant exposure to affected regions may face higher risk premiums, while defense companies might see increased demand for their products. On the other hand, sectors like tourism and international retail can suffer losses due to decreased consumer confidence and disruptions in global supply chains. Understanding these historical and current geopolitical dynamics is crucial for investors and policymakers. It allows them to better prepare for potential market fluctuations and to develop more resilient economic policies and investment strategies that can withstand geopolitical shocks. The global geopolitical landscape is continually evolving, with new hotspots emerging that could significantly impact international markets. By examining potential future scenarios, investors and policymakers can better prepare for the uncertainties that lie ahead. As digital transformation accelerates, technological rivalries, particularly in cybersecurity and artificial intelligence, are likely to intensify. Nations leading in technology could enforce policies that impact global trade and market stability. For instance, restrictions on technology transfers and cyberattacks on critical infrastructure could trigger significant market volatility. Climate change is increasingly recognized as a critical geopolitical issue that will shape future conflicts and alliances. Competition for scarce resources, such as water and rare minerals necessary for high-tech industries, could lead to increased tensions between countries. These developments might influence commodity markets and environmental regulation policies, affecting sectors ranging from energy to manufacturing. The reconfiguration of global alliances, with an increasing focus on Indo-Pacific dynamics, may redefine trade and security policies. The strengthening of ties between Western nations and Indo-Pacific countries in response to China's growing influence could reshape economic and military strategies, influencing global investment flows and currency markets. The trend towards economic decoupling, especially between major powers like the USA and China, could lead to the formation of parallel global markets. This scenario might force companies and investors to navigate a more fragmented economic landscape, impacting everything from supply chains to investment strategies. The Middle East remains a critical region due to its substantial oil reserves and strategic location. Potential scenarios involving changes in political regimes or renewed negotiations over nuclear programs, such as Iran's, could dramatically affect oil prices and energy stocks globally. Let's dive into some common questions for Chapter 2, Global Geopolitical Tensions and Economic Impact.
With recent military actions in the Middle East, how stable are global oil supplies currently?
Despite the geopolitical tensions, global oil supplies have remained stable. The robust production and strategic reserves, along with effective naval presence in key areas, have mitigated potential disruptions. However, the situation remains fluid and requires continuous monitoring.
How do fluctuations in oil prices impact global economies?
Fluctuations in oil prices can have significant ripple effects on global economies. Higher oil prices can increase transportation and manufacturing costs, leading to higher inflation. Conversely, lower prices can reduce energy costs but might hurt oil exporting countries. Economic stability heavily depends on balanced oil prices. Chapter 3: The Real Economy's GDP Growth and Consumer Behavior. The latest data indicates a slowdown in U.S. economic growth, with real GDP increasing at an annual rate of 1.6% in the first quarter of 2024, a decrease from 3.4% in the fourth quarter of 2023. This slowdown is primarily attributed to a decrease in inventory investment, although consumer spending and housing investment have seen increases. The advance in consumer spending has partially offset the drag from other sectors, highlighting its continuing role in supporting the economy. The deceleration in GDP growth can be linked to several factors, including diminished excess savings among consumers, plateauing wage gains, and a shift in government fiscal policies. Increased interest rates have also played a role, making borrowing more expensive and dampening business investment and consumer spending on big-ticket items. These elements collectively signal a cautious economic environment moving forward. Despite the general slowdown, consumer spending has been resilient, supported by strong employment levels and household balance sheets. However, the housing market has experienced mixed impacts. On one hand, housing investments have increased, but on the other, the market faces challenges from higher mortgage rates, which have cooled some of the demand. The current economic conditions and the tempered outlook for GDP growth influence market sentiment, leading to cautious optimism in some sectors while preparing for potential challenges in others. The outlook remains guarded, with consumer behavior likely to be more conservative in response to economic uncertainties and the shifting dynamics of employment and income growth. Let's dive into some common questions for Chapter 3: The Real Economy's GDP Growth and Consumer Behavior.
What are the main drivers behind the recent slowdown in GDP growth?
The slowdown can be attributed to several factors, including higher interest rates affecting borrowing and spending, a decrease in government stimulus, and global economic uncertainties impacting trade and investment decisions.
How is consumer behavior impacting the economy currently?
Consumer spending continues to be a crucial support for the economy, helping to mitigate the impact of negative growth factors. However, the pace of spending is expected to moderate as consumers become more cautious in response to economic uncertainties. Chapter 4: Corporate America Earnings Season and Market Reactions. This earnings season highlights a tale of two landscapes within corporate America. On one side, tech giants like Microsoft and Alphabet continue to excel, powered by robust demand for cloud services and digital advertising. On the other side, we see companies like Tesla grappling with significant supply chain challenges, directly impacting their bottom line. Meta Platforms and Snap Incorporated are threading through the competitive digital advertising market with varied success. Positive earnings from Microsoft and Alphabet have provided a steady hand to the tech sector, encouraging rallies in stock prices that help buffer against broader market downturns. In contrast, Tesla's struggles underscore the vulnerabilities facing the automotive industry, influenced by external supply chain factors. Investor confidence this season is buoyed by strong performances from tech leaders, prompting continued investment in technology stocks. However, the challenges encountered by Tesla and the intense competition faced by Meta and Snap invite a more cautious approach from the investment community, highlighting the need for vigilance against potential market shifts. These earnings results are pivotal in shaping investment strategies and sectoral outlooks. They offer crucial insights into corporate health and economic indicators, guiding strategic shifts in investment that could resonate across the global financial landscape. This earnings season acts as a vital indicator of health within corporate America, particularly illuminating within the tech sector. Companies like Microsoft and Alphabet have showcased growth and adaptability, whereas others like Tesla face ongoing challenges that mirror wider economic uncertainties. These diverse outcomes not only reflect on the company's performances but also significantly impact broader market trends and investment strategies, guiding us through a dynamically evolving economic environment. Microsoft MSFT earnings highlights for Q1 2024. Exceeded earnings expectations by 4%, demonstrating robust financial performance and effective strategy execution. Microsoft demonstrated robust financial growth, with revenue climbing 13% to approximately $56.5 billion. This increase was driven mainly by its cloud services and productivity software, with a notable rise in operating income to about $26.9 billion, reflecting efficient cost management. The growth in cloud services, including Microsoft Azure, is attributed to widespread adoption across various industries, while productivity tools like Microsoft 365 and Dynamics 365 continue to support remote and hybrid work environments. Microsoft's commitment to AI integration across its services, such as Azure AI and GitHub Copilot, has enhanced product offerings and driven innovation and efficiency. Additionally, the company's aggressive expansion of its global cloud infrastructure and continuous investment in sustainability practices, aiming to be carbon negative by 2030, underscore its commitment to responsible corporate practices. Looking forward, Microsoft's focus remains on key areas such as cloud computing and AI, with ongoing investments set to maintain its leading position in the tech industry, though it faces challenges from global economic conditions and competitive pressures. Alphabet (GOOGL) earnings highlight for Q1 2024. Exceeded earnings expectations by 25%, demonstrating robust financial performance and effective strategy execution. Alphabet, the parent company of Google, showcased strong financial results driven by its diverse revenue streams. The company reported a robust performance in both its advertising and cloud computing sectors. Alphabet's advertising revenue continued to dominate, benefiting from increased digital consumption and advertising spend across its platforms, including Google Search and YouTube. Innovations in ad technology and targeted advertising capabilities have allowed Alphabet to maintain a leading position in the digital advertising market. Google Cloud showed significant growth, reflecting the ongoing demand for cloud services and solutions. This growth is part of a broader trend where businesses across various industries are accelerating their digital transformation strategies, thereby increasing their reliance on cloud infrastructure and services. Alphabet's strategic focus remains firmly on innovation and the development of future technologies, particularly in areas like AI, machine learning, and quantum computing. Alphabet continues to invest heavily in artificial intelligence, integrating AI across its products and services to enhance functionality and user experience. This includes AI-driven analytics in Google Cloud, AI enhancements in consumer applications like Google Photos and Google Assistant, and groundbreaking research through DeepMind. Beyond AI, Alphabet is exploring advancements in other emerging technologies such as quantum computing and autonomous driving through Waymo. These initiatives not only promise to open new business avenues but also position Alphabet at the cutting edge of technological innovation. The market's response to Alphabet's Q1 2024 earnings was overwhelmingly positive, reflecting confidence in the company's ability to sustain growth despite challenges such as market saturation and competitive pressures. Investors showed renewed confidence in Alphabet's growth trajectory, buoyed by its strong earnings report and continued market leadership. Looking forward, Alphabet is expected to continue its growth, driven by its robust advertising business and expanding cloud services. However, the company's future performance is also closely tied to its ability to innovate and adapt to changes in technology and market demands. Overall, Alphabet's strategic investments in AI and future technologies, coupled with its strong performance in core areas, suggest a promising outlook. The company is well-positioned to capitalize on ongoing digital trends, making it a critical player in the global technology landscape and attracting ongoing investor interest and market attention. Tesla, TSLA, earnings highlights for Q1 2024. Missed earnings estimates by 9%, reflecting challenges in operational efficiency and market conditions. Tesla faced several significant challenges in the quarter, impacting its production and overall performance. Tesla encountered hurdles in its production lines primarily due to disruptions in supply chains affecting the automotive industry worldwide. These issues were compounded by the global shortage of semiconductors, crucial for the advanced electronics in Tesla vehicles. Beyond semiconductors, Tesla also dealt with delays in the delivery of critical components such as batteries and specialized materials used in their electric motors and drivetrains. These disruptions were partly due to geopolitical tensions and ongoing logistical constraints post-pandemic recovery phases. Despite the operational challenges, Tesla managed to post notable financial outcomes for Q1 2024. Tesla reported earnings per share slightly lower than previous quarters, yet still outperformed some analysts' expectations considering the operational challenges. This resilience is a testament to Tesla's robust demand and pricing strategy. Revenue growth was influenced by the continued high demand for Tesla's models, despite production slowdowns. The company's ability to maintain a strong market presence and customer loyalty helped buffer the potential downturns from production delays. In response to the Q1 challenges, Tesla implemented several strategic initiatives to stabilize operations and pave the way for future growth. Tesla continued to innovate with enhancements to existing models and the development of new ones, which include improvements in battery technology and energy efficiency. These innovations aim to solidify Tesla's market leadership in the electric vehicle sector. Tesla is pushing forward with its sustainable energy solutions, such as solar panels and integrated battery storage systems. These initiatives are part of Tesla's broader strategy to create a sustainable energy ecosystem, which complements their electric vehicles. To combat the ongoing supply chain issues, Tesla has been working on diversifying its supplier base and increasing the localization of its supply chain. This includes investments in new production facilities closer to key markets to reduce dependency on overseas components. Overall, Tesla's strategic responses to Q1 challenges demonstrate the company's agility and commitment to maintaining its pioneering status in the electric vehicle and clean energy industry. These efforts are designed not only to address immediate challenges but also to secure long-term growth and stability in a rapidly evolving global market. Meta Platforms, Meta, earnings highlights for Q1 2024. Exceeded earnings expectations by 9%, demonstrating robust financial performance and effective strategy execution. Meta Platforms reported its financial results for Q1 2024, showcasing significant insights into its revenue streams and profitability. Meta continued to dominate the digital advertising space, with its platforms Facebook and Instagram driving substantial revenue. Despite facing intense competition and market saturation, Meta's advertising revenue grew, benefiting from sophisticated targeting capabilities and the high engagement levels of its user base. The strong advertising revenue contributed positively to Meta's overall earnings. The company exceeded analysts' expectations in terms of both revenue and profit, signaling effective cost management and successful monetization strategies amidst challenging economic conditions. Meta is actively pursuing several strategic initiatives to maintain its competitive edge and foster long-term growth. This includes significant investments in virtual/augmented reality (VR/AR) technologies, viewing them as central to its future growth. These investments aim to create immersive user experiences that extend beyond traditional social media interactions. To enhance its market positioning, Meta has been diversifying its offerings, including strengthening its e-commerce capabilities through Instagram and Facebook shops. This diversification helps Meta capitalize on new revenue streams and reduces its dependence on advertising alone. Meta's long-term growth outlook remains optimistic, driven by its innovative strategies and strong market positioning. Continuing innovation, particularly in AI and machine learning, is expected to drive future user engagement and advertising efficiency, key factors in Meta's growth strategy. Expansion into new markets, particularly emerging markets where internet penetration is growing, is expected to increase Meta's user base and open up new advertising opportunities. Investor sentiment towards Meta is generally positive, bolstered by the company's robust earnings report and strategic investments in future technologies. However, challenges such as regulatory scrutiny and competition from newer social platforms could impact investor confidence. Overall, Meta Platforms is strategically positioning itself not only as a social media giant but also as a leader in next-generation technology applications. This strategic focus is expected to support its long-term growth and help it navigate the complexities of the rapidly evolving digital landscape. Snap Incorporated, Snap, earnings highlights for Q1 2024. Exceeded earnings expectations by 26%, demonstrating robust financial performance and effective strategy execution. Snap Incorporated showcased a strong first quarter in 2024, with noteworthy financial performance largely driven by its robust advertising growth. The company's strategic positioning in the digital advertising market allowed it to capitalize on the increasing shift toward mobile and online advertising. Snap's advertising revenue saw a significant increase, driven by higher engagement rates on its platform and the successful implementation of advanced targeting technologies. The company's focus on innovative advertising formats, such as augmented reality ads and branded content, has resonated well with advertisers looking to connect with younger demographics. The positive trend in advertising revenue contributed to an overall improvement in Snap's financial health. The company reported a solid rise in total revenue, along with a notable reduction in losses compared to previous quarters, underscoring effective cost management and operational efficiency. Snap continued to innovate in the first quarter, introducing several new features and enhancements aimed at boosting user engagement and expanding its user base. Snap has been proactive in rolling out new interactive features, such as advanced filters, games, and more engaging Snap Stories options. These features are designed to increase the time users spend on the app and enhance the overall user experience. Among the notable new features are enhancements to the Snap Map and the introduction of more comprehensive in-app shopping experiences, which integrate seamlessly with Snap's advertising offerings. These developments not only improve user engagement but also open new revenue streams for the company. Investors have reacted positively to Snap's Q1 performance, appreciating the company's agility and innovative approach in a competitive social media landscape. Snap is well positioned to leverage its niche in engaging a younger audience, a demographic highly coveted by advertisers. Its ongoing innovations in AR and interactive content are seen as critical drivers for future growth. Looking ahead, Snap is expected to continue focusing on expanding its advertising capabilities and enhancing user engagement through technological innovations. The company's investments in AI and machine learning are projected to further improve advertising personalization and effectiveness, which could lead to increased revenue. Snap's performance and strategic initiatives have broader implications for the social media sector and digital advertising trends. Snap's success with innovative advertising solutions is setting trends within the social media industry, prompting competitors to also innovate more aggressively in AR and interactive advertising. As digital advertising continues to evolve, Snap's focus on integrating commerce and advertising is indicative of a broader industry trend towards more immersive and integrated user experiences. Overall, Snap Incorporated's first quarter of 2024 highlights a company on the rise, with solid financial results backed by strong advertising growth and continuous product innovation. The company's strategic focus on user engagement and innovative advertising positions it well for sustained growth in the evolving social media landscape. Amazon.com Incorporated, AMZN, earnings highlights for Q1 2024. Exceeded earnings expectations by 16%, demonstrating robust financial performance and effective strategy execution. Amazon.com Inc. demonstrated strong financial performance in the first quarter of 2024, notably exceeding earnings expectations. The company's success can be attributed to several strategic areas and robust growth across its diverse operations. Amazon continues to enhance its dominant position in the e-commerce sector by optimizing its distribution network and logistics, streamlining delivery processes, and improving customer service, which is especially effective in North America and Europe. The advertising division has become an integral part of Amazon's revenue model. Leveraging vast consumer data, Amazon offers highly targeted advertising solutions that are increasingly preferred by advertisers for their effectiveness and reach. Amazon is actively pursuing expansion in international markets, with a strategic focus on emerging economies. This approach helps mitigate risks associated with mature markets and bolsters its global market presence. Demonstrating a commitment to environmental sustainability, Amazon invests in renewable energy projects and introduces eco-friendly packaging solutions. These efforts are part of its broader strategy to minimize its ecological footprint while enhancing corporate responsibility. Amazon's first quarter results of 2024 reflect a company that is both financially robust and strategically forward-looking, positioning itself to continue its global leadership in technology and retail sectors. Apple Incorporated (AAPL) earnings highlights for Q1 2024. Exceeded earnings expectations by 2%, demonstrating robust financial performance and effective strategy execution. Apple Incorporated exceeded earnings expectations by 2%, demonstrating robust financial performance and effective strategy execution. The company reported revenue of approximately $120 billion, a 2% increase year-over-year, and a rise in earnings per share (EPS) of 16% to $2.18. This strong performance was driven by robust iPhone sales and record-breaking services revenue. Apple's active device base reached a new high of 2.2 billion across all product segments and regions. The quarter also generated nearly $40 billion in operating cash flow, with about $27 billion returned to shareholders through dividends and buybacks. Let's dive into some common questions for Chapter 4, Corporate America Earnings Season and Market Reactions.
Max, with tech giants like Microsoft, Alphabet, and now Apple and Amazon showing strong performances. What's driving their success during this earnings season?
The success of these companies is driven by their robust sectors like cloud computing, digital advertising, and diversified business models. Microsoft's Azure, Alphabet's Google Cloud, and Amazon's AWS have all seen substantial growth. Apple's continued innovation in its product lines also plays a significant role in its financial success.
Interesting. And with Tesla facing supply chain challenges, how are they managing to mitigate these impacts?
Tesla has been proactive in addressing these challenges through strategic supply chain adjustments and ramping up domestic production capabilities. This helps them maintain their market leadership in the electric vehicle industry despite these hurdles.
Switching to Meta platforms, how is the company adapting its strategy in response to competitive pressures in digital advertising?
Meta is continuously evolving its advertising strategies, heavily investing in AI to enhance user engagement and ad targeting, and pushing into VR and AR to open new channels for immersive advertising experiences.
And what about Snap Incorporated? How are they standing out in the crowded social media landscape?
Snap is focusing on dynamic advertising formats and interactive user experiences, attracting a younger audience with their augmented reality and innovative content delivery, leading to substantial revenue growth.
Finally, considering the current market dynamics, what should investors be looking out for as the earnings season progresses?
Investors should monitor companies that show adaptability and innovation in their operations and product offerings, particularly in technology sectors. This will provide key insights into their long-term growth potential and resilience.
Thanks for these comprehensive insights. It helps to understand the nuances behind these earnings reports and their broader market implications.
Chapter 5: Navigating the Storm of Gold, Silver, and Strategic Investment Shifts in Turbulent Times. The global economic landscape presents a challenging environment, marked by shifting interest rate expectations and geopolitical tensions. This scenario has led investors to recalibrate their strategies, increasingly turning to safe haven assets like gold and silver while also considering the robustness of big tech companies in a potentially prolonged high-rate environment. As the year began, investors anticipated multiple rate cuts by the Federal Reserve due to earlier economic indicators. However, recent macroeconomic data suggesting resilience in the economy has shifted these expectations, with market consensus now predicting fewer rate cuts. This change has reignited interest in large tech companies known for their minimal debt levels. Such firms are perceived as more resilient to interest rate increases, as their financial stability is less impacted by borrowing costs. The ongoing conflicts, notably between Israel and Hamas and the escalating tensions between Israel and Iran, have significantly driven up the prices of gold and silver. These metals are traditionally seen as safe havens in times of uncertainty, and their appeal increases alongside geopolitical risks and economic instability from various global quarters, including ongoing issues in Ukraine and rising debt levels in major economies. Central banks have maintained strong buying activity in the gold market, using the precious metal to hedge against potential economic downturns. This trend underscores gold's enduring role in national economic strategies and its importance in central banking reserves. Despite typical challenges associated with high interest rates, gold and silver continue to attract attention as relatively undervalued safe havens. The high valuation of many stocks in the S&P 500, combined with economic uncertainties, makes these metals appealing. Moreover, the volatility and regulatory challenges in sectors like biotech have led some investors to adopt defensive positions, such as shorting biotech stocks using ETFs like LABD. Speculation about Federal Reserve interest rate policies continues to influence the dollar's strength, which in turn affects the price of dollar-denominated assets like gold. Expectations of a weaker dollar in the future could enhance gold's attractiveness, potentially increasing its demand among global investors. This intricate financial backdrop underscores the importance for businesses and investors to adapt their strategies. Expanding exposure to precious metals and strategically positioning against volatile sectors forms a crucial part of broader risk management strategies. This adaptation is especially vital as investors navigate through the interplay of high market valuations, geopolitical risks, and regulatory changes that could impact investment strategies and compliance. For more insights on how geopolitical issues are influencing investment strategies and detailed market analysis, financial news sources like Zawiya provide valuable information. Let's dive into some common questions for Chapter 5, Navigating the Storm of Gold, Silver, and Strategic Investment Shifts in Turbulent Times.
Max, with the shift in macroeconomic forecasts and investor expectations on interest rate cuts, how should investors adjust their strategies?
That's a great point. This year, expectations have adjusted from anticipating multiple rate cuts to potentially just one. Investors are looking towards sectors less impacted by high interest rates, particularly tech giants without debt, as their financial resilience makes them less sensitive to borrowing costs.
With ongoing geopolitical tensions, why are gold and silver still considered attractive investments?
Gold and silver are traditional safe havens during times of uncertainty. The conflicts between Israel and Iran, along with the situation in Ukraine, drive investors towards these metals. Despite the high-rate environment, their appeal as protective assets against global instability and inflation keeps their demand high.
Considering the challenges with rising interest rates, why do gold and silver remain compelling investments?
Even though higher interest rates typically reduce the allure of non-yielding assets like gold and silver, the current backdrop of high inflation and geopolitical risks maintains their status as safe investments. Moreover, speculations around Federal Reserve policies influence the dollar's strength, affecting gold prices since a weaker dollar can make gold more affordable for investors holding other currencies.
What's behind the strategic shorting of the biotech sector?
Investors are strategically shorting the biotech sector due to its volatility and regulatory challenges. Using ETFs like the LABD allows them to capitalize on potential downturns, providing a hedge against other investments in uncertain times. Innovative business idea, Black Swan Risk Management AI tool. Inspired by discussions on market dynamics and the current geopolitical and economic climate, the Black Swan Risk Management AI tool aims to aid investors in hedging against rare yet potentially devastating market events. This tool continuously scans global news and financial data to detect signals of potential black swan events, such as geopolitical conflicts or sudden economic downturns. Utilizing advanced algorithms, it evaluates the potential impact of identified risks on investment portfolios and recommends immediate actions, like hedging strategies. When significant market drops or specific news triggers occur, the tool automatically suggests or executes hedging strategies. This includes purchasing out-of-the-money, OTM, VIX options like VXX to guard against market crashes, offering a cost-effective insurance method against severe losses. Users can set specific parameters for alerts based on their risk tolerance and investment horizon. For instance, a trigger might be set for buying VIX options if the S&P 500 drops by more than 3% in a single day, combined with specific types of geopolitical news. Additionally, the platform offers educational content on black swan events and their impacts, along with a simulation tool that allows investors to see potential outcomes of different scenarios and strategies. This AI tool caters to the increasing demand among individual investors and financial institutions for tools that can provide advanced warning and protective strategies against sudden market downturns. Let's dive into some common questions for the innovative business idea, Black Swan Risk Management AI Tool.
Max, how could this Black Swan risk management AI tool be practically implemented in today's market?
The first step in implementing this AI tool would be to develop a robust algorithm that can analyze vast amounts of real-time data from global news sources and financial markets. This AI would need to identify potential black swan events by recognizing specific patterns or outliers in the data that could indicate a sudden market downturn or geopolitical crisis. The implementation would also require building a responsive interface that allows users to customize their risk parameters and receive timely alerts.
That sounds quite comprehensive. What technological infrastructure is required to support such a tool?
The infrastructure would need to be highly scalable and secure, as it would handle sensitive financial data and perform complex computations quickly. Utilizing cloud computing resources would be essential for managing the data load and ensuring the AI can operate efficiently 24/7. Additionally, integrating with existing trading platforms and financial management systems would be crucial to provide users with seamless, actionable insights.
Could you explain how this tool would interact with users' existing investment strategies?
Certainly. The tool is designed to be a complementary asset in an investor's toolkit. It can integrate with users' existing portfolios and provide recommendations for hedging strategies based on their individual risk profiles. For instance, if the tool detects a potential financial downturn, it could suggest purchasing specific options or other financial instruments to hedge against potential losses, all while keeping in line with the user's overall investment goals.
What about potential regulatory hurdles for deploying such an AI tool in the financial market?
Regulatory compliance is paramount. The tool would need to adhere to all relevant financial regulations, including those related to data security and privacy. Working with legal experts and regulatory bodies from the early stages of development would help ensure the tool complies with all necessary regulations and can be trusted by users to manage financial risk responsibly.
Finally, what do you see as the main challenges in bringing this tool to market, and how can they be overcome?
The main challenges would likely involve ensuring the accuracy and reliability of the AI predictions, gaining user trust, and navigating the complex regulatory environment. These can be addressed by conducting extensive testing of the AI system, transparently communicating the tool's capabilities and limitations to potential users, and maintaining a rigorous compliance regime. Continuous learning and adaptation based on user feedback and market changes will also be critical for the tool's long-term success and relevance in the market. Stay connected.
As we wrap up today's insightful exploration of AI in finance, let's delve into the unique artworks that accompany our discussions. Max, there's more to these artworks than meets the eye, isn't there?
Absolutely. Our luxury conceptual digital art is not just a feast for the eyes, it's crafted with potential investment value in mind. Each piece is inspired by and linked to a specific chapter in our podcast, creating a unique narrative context that enhances its appeal. Drawing inspiration from the trajectory of Andy Warhol's iconic prints, which soared in value over time, we anticipate our artworks could similarly appreciate as digital and AI-influenced art gains broader recognition.
Warhol's work took some time to be fully appreciated, didn't it? How does that relate to our art?
That's right. Initially, Warhol's pop art faced skepticism and was met with mixed reactions. Some of his early works were priced modestly, often sold for a few $100s. Yet, over the years, these same pieces have appreciated enormously in value, with some reaching tens of millions at auctions. For instance, Warhol's 8 Elvises originally sold for $100,000 in the 1960s and later fetched over $100 million. We hope our art follows a similar trajectory, initially niche but growing in significance as the intersection of technology and luxury art becomes more mainstream.
And our listeners play a role in this as well, correct?
Indeed, they do. By engaging with our artwork on social media, especially on Twitter where we frequently post updates, our listeners help determine which pieces we feature. The most popular selections by our listers are initially offered for sale on Etsy. Looking ahead, we're excited to announce plans for the Finance Frontier AI 2025 Art Collection, a future marketplace where these artworks will be traded like collector's cards. For truly standout pieces, we'll offer exclusive, limited edition artworks as NFTs, showcasing the best of our annual collections.
So, engagement from our listeners can influence which artworks are available?
Exactly. We encourage everyone to let us know if a particular piece captures their imagination. You can reach out through the contact form linked in our show notes or directly comment on our Twitter posts. This not only helps us gauge which artworks are most popular, but also fosters a vibrant community around this innovative blend of art and technology.
For our listeners who want to dive deeper and stay ahead with the latest developments, what do you recommend, Max?
I strongly recommend subscribing to our AI Finance 5 newsletter. It's your weekly summary of the top 5 insights from our podcast, crafted to give you a leading edge in AI and finance. Just fill out the contact form linked in our show notes, and every Friday, you'll receive a concise overview of crucial developments directly in your inbox.
Fantastic! And for those who want to continue this discussion and not miss any of our episodes, where should they go?
To ensure you never miss an episode, subscribe to us on Apple Podcasts or Spotify. Your subscription helps us climb the charts and reach more listeners, expanding our community of tech-savvy investors. Plus, it's the best way to stay updated with our latest episodes and the evolving world of AI and finance.
Thank you to everyone who has joined us on this journey. Your curiosity and engagement are what drive us forward. Stay connected, keep exploring, and together, let's uncover the future of technology and finance.
Disclaimer and acknowledgements. This content is for educational purposes only and is not intended as financial or legal advice. We thank sources such as Zawiya, TechCrunch, McKinsey & Company, Bloomberg, Reuters, CNBC, Forbes, Financial Times, The Wall Street Journal, Science Daily, and Investing.com for their contributions to the field, which inspire our discussions. Copyright 2024 Max Vanguard. All rights reserved.